Welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and today's episode is all about leveling up. We're talking about scaling your trading capital, not through luck, not through overnight gains, but by managing multiple funded accounts with strategy, structure, and discipline. If you're an experienced trader working with prop firms or considering joining one, chances are you've thought about how to grow your capital base. Maybe you've passed a few challenges. Maybe you're already funded. The next question is, how do you scale safely and sustainably? Because here's the truth, more capital doesn't just mean more opportunity. It also means more complexity, more responsibility, and more risk. So today we're unpacking the systems, tools, and mindset required to manage multiple funded accounts effectively. And we'll also dig into how to navigate scale-up programs offered by proprietary trading firms. Let's get into it. The challenges of scaling in prop trading. Before we dive into strategies, let's get real about the challenges. Scaling up is exciting, but it comes with friction. Increased complexity, you're not managing one account anymore. You're balancing several, sometimes across different platforms, brokers, and funding rules. Heightened risk exposure. More capital means higher stakes. Every mistake costs more. Psychological pressure. When you're trading 5 or 10 times more capital than before, the fear of loss can mess with your head. Operational inefficiencies. Manually entering trades across multiple accounts? That's a recipe for errors and burnout. Execution differences. Not all brokers execute the same. One platform might have faster fills, tighter spreads, or different margin rules. You have to adjust accordingly. And let's not forget regulatory compliance. Some prop firms have firm restrictions about managing multiple accounts or using third-party tools. So staying up to date on firm policies is essential. Scaling isn't about just trading bigger. It's about building systems that allow you to trade smarter. Strategy 1. Use trade copier software. The first tool every serious multi-account trader needs is a trade copier. This software lets you place a trade on one master account, and it automatically replicates the trade across your other funded accounts. No manual copying. No missed entries. Here's why it matters. Efficiency, you save time and avoid mistakes. Consistency, every trade is executed identically, reducing human error. Custom risk control, you can assign different risk levels to different accounts. Scalability, whether you're managing 2 accounts or 12, the workflow stays the same. Look for copier tools that offer low latency for instant execution, custom lot sizing and risk multipliers, compatibility with various brokers and platforms, selective copying, so you're not forced to send every trade to every account. And most importantly, security. Make sure your credentials and trading data are protected. But here's a heads up. Some prop firms prohibit or limit trade copiers, especially if they're managing risk on a per trader basis. Always check their terms before installing anything. Strategy 2. Diversify your trading strategies. One of the biggest mistakes traders make when scaling is using one strategy across every account. That's risky. If your strategy hits a drawdown or the market conditions shift, you could blow multiple accounts simultaneously. The fix? Diversify your strategies. Here are a few ways to do it. Different time frames. Use scalping on one account, day trading on another, swing setups on a third. Asset class variation, trade Forex on one, indices on another, commodities or crypto on the rest. Strategy variation, combine trend following, mean reversion, breakout plays, and news-based trading. Risk levels, allocate aggressive strategies to some accounts and conservative ones to others. News versus technical setups, have one account just for economic events and others for pure technicals. This kind of strategic diversification reduces your correlation risk and makes your trading portfolio more resilient to volatility and unpredictable markets. Strategy 3. Time management is everything. Handling multiple accounts isn't just about trade entries. It's about managing your time like a pro. Because here's what happens: without structure, things get messy. You miss setups, mismanage risk, and make emotional decisions. Let's fix that. Try these time management tactics. Automate execution using trade copiers and alerts. Segment your day, block time for review, execution, and performance tracking. Use analytics dashboards to monitor key metrics across accounts. Prioritize high performing accounts. Focus your energy where ROI is strongest. Set clear trading rules per account. Not every account should be aggressive. Use dedicated screens if possible. This helps visually separate strategies and workflows. And finally, keep a trading journal for each account. Document wins, losses, mistakes, and adjustments. This structure will give you the clarity to stay calm, focused, and efficient, especially when the pressure is on. Strategy 4. Scaling capital requires smarter risk management. Let's be blunt. If you're managing $10,000 across accounts, you can afford to be flexible. But if you're handling $100,000 or more, you need professional grade risk controls. Here's what that looks like. Adjust position sizing based on total exposure, not just individual account balance. Set drawdown limits daily, weekly, monthly. Always use stop losses and predefined exits. Monitor asset correlation. Don't overexpose to one market across multiple accounts. Use hedging if needed, especially during high volatility periods. Analyze portfolio-wide risk. Your risk exposure isn't per account, it's global. And create risk-based scaling rules. Don't increase position sizes just because you have more capital. Do it based on proven performance and market conditions. Capital protection is everything. Scaling should amplify your system, not expose its weaknesses. Scaling with prop firms, understanding scale-up programs. Let's talk about the long game. Most proprietary trading firms don't just hand you capital once. You can earn more capital over time through what's called a scale-up program. These programs reward consistency, discipline, and profitability. They're ideal for traders looking to build a full-time income from prop trading. Here's what you'll often find. Performance-based capital increases. Higher profit splits as you progress. Reduced restrictions like fewer max drawdown limits or lot size caps. Milestone tracking. Hit certain metrics and unlock more capital. Profit retention. In some cases, you get to keep part of your capital allocation long term. Not all prop firms offer the same structure, so do your homework. Choose a firm that aligns with your growth goals. And if you're actively looking, check out crystalballmarkets.com. Their prop programs are designed for scalable growth, with tools and support tailored for traders aiming to manage serious capital. Final thoughts: scaling up the right way. Scaling is more than passing a challenge or adding another funded account. It's about building a business, not just taking trades. To do it right, use tech like trade copiers to streamline execution. Diversify your strategies to spread risk. Structure your time like a pro. And always lead with risk management. The traders who scale successfully aren't the ones who chase the biggest wins. They're the ones who control risk, stay consistent, and build reliable systems that can grow with them. So if you're on that path, keep going. It's not easy, but it's absolutely possible with the right tools and mindset. That's a wrap for today's episode of Financial Market Insights for Traders. I'm Sophia. Thanks for tuning in. If this episode helped clarify your next steps in managing multiple funded accounts, share it with your trading group and leave a review. And as always, trade smart, scale smart, and stay in control. Until next time.